Welcome to the video. Today we will explore how to maximize your flexible spending accounts when changing jobs mid-year. We will focus on the practical differences between Health Care FSAs and Dependent Care FSAs, how contribution rules work, how to legally and efficiently maximize benefits, and how to avoid pitfalls. We will move step by step, comparing plan rules, walking through examples, and ending with a concise checklist. Let's begin. Before we dive deeper, please note this content is for education only and is not tax, legal, or HER advice. Plan details and IRS limits change. Your employer's plan, local law, and timing can all affect outcomes. Always review plan documents, verify current year limits, and consult a qualified professional before making elections or changes. Now, let's proceed to the agenda. Here's our agenda. We will begin with a quick refresher of HCFSA versus DCFSA. Then we will detail the Health Care FSA Spend First Rule and the Dependent Care FSA Contribute First Rule. Next, we will visualize the strategy with a flow chart and timeline, review concrete examples, and share pro tips. We will also include a short quiz, then close with an actionable checklist and key takeaways. Let's move on to the refresher. At a high level, there are two common FSAs. The Health Care FSA follows the Uniform Coverage Rule, which means your full annual election is available on day one of the plan year. The Dependent Care FSA follows a Contribute First model, which means you can only be reimbursed up to the amount you have actually contributed so far. This difference becomes critical when switching jobs mid-year. Now let's compare them side by side. Here is a snapshot comparison. On the left, Health Care FSAs. The Uniform Coverage Rule makes the full elected amount available immediately. It covers eligible medical, dental, and vision expenses. Importantly, limits are applied per employer plan, not per individual, across all jobs, which enables a potential mid-year double election when you switch employers. On the right, Dependent Care FSAs. Reimbursements are limited to what you have contributed so far. The annual limit is per household. This means you must sum contributions across all employers in the year. Over-contributing results in the excess being added back to taxable income. Next, let's zoom into the HCFSA strategy. Let's focus on the HCFSA Spend First Rule. Under the Uniform Coverage Rule, your full annual election is available from day one. This means that even if you have contributed very little through payroll yet, you can still be reimbursed up to your full annual election. If you then leave your job before contributing the full amount through payroll, the plan typically absorbs the shortfall. This is a common feature of cafeteria plans, but always confirm your specific plan documents. Because HCFSA limits apply per employer plan during the year, a mid-year job change can allow a second full election at the new employer, effectively doubling available pre-tax dollars. For example, you might use your full election early at Job A and then elect the full amount again at Job B. Keep careful records and submit claims according to each plan's deadlines. Here is a simplified HCFSA example using a $3,200 limit. At Job A, you elect $3,200 and spend it early. You leave after contributing only $800 through payroll, but you were reimbursed the full $3,200. The plan typically absorbs the $2,400 difference under cafeteria plan rules, subject to your plan. At Job B, you elect another $3,200 and contribute and claim as usual. Across both plans, you accessed $6,400 of eligible reimbursements in 1 year. This illustrates how limits are effectively per plan. Always verify your plan rules and current year limits. Now let's turn to the Dependent Care FSA. Here, reimbursements are limited to what you have contributed so far, so you cannot draw the full annual election on day one. The annual limit applies per household across the entire year and across all employers. A commonly cited federal limit is around $5,000, but always verify your current year IRS limit and your employer's plan communications. If you exceed the allowed household limit when combining contributions from multiple jobs, the excess will be added back to taxable income, which negates the benefit. Therefore, track contributions carefully and ensure you have eligible dependent care expenses and submit claims before the plan's deadlines. This timeline highlights a typical mid-year switch. In the first section, during the first quarter at Job A, you elect and spend the HCFSA early, while DCFSA contributions accrue monthly. In April, you resign. During the gap period, you organize receipts, submit final claims for both accounts according to plan deadlines, and confirm final payroll contributions. At Job B, from May through December, you elect the HCFSA at the full plan maximum again, while continuing DCFSA contributions. Throughout the remainder of the year, you carefully ensure the combined DCFSA contributions across both employers do not exceed the household limit, and that all claims are submitted on time. Next, let's reinforce this with a decision flow. This decision flow shows the logic behind double elections for HCFSA. First, confirm eligibility and plan rules at Job A, and elect the full amount if appropriate. Use eligible expenses and keep documentation. If you are switching jobs mid-year and the new employer offers an HCFSA, you may elect the full maximum again because limits are per employer plan. Throughout, verify current year limits, confirm plan documents, and keep receipts. If the new employer does not offer HCFSA, the path ends after Job A. Now, let's practice with a quick quiz. Quiz time. Question: true or false? HCFSA. Annual limits apply per employer plan, allowing 2 full elections in 1 year if you switch jobs mid-year, and both employers offer HCFSA. Option A, true. Option B, false. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is true. Health Care FSA limits are applied per employer plan, which can allow 2 full elections if you switch jobs, and both employers offer HCFSA. Always verify plan rules and current year limits. Here's the next quiz question. Which statement about DCFSA is correct when changing jobs mid-year? Option A. You can be reimbursed the full annual election on day 1 at Job A. Option B. The household must track total contributions across all employers to avoid exceeding IRS limits. Option C. Excess contributions are forfeited and never taxable. Option D. You can only claim expenses after your final working day at Job A. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is that the household must track total contributions across all employers to avoid exceeding the IRS annual limit. Dependent Care FSAs are contribute first, and overages are typically added back to taxable income, negating the benefit. Now let's move into practical steps you can take. Here are your actionable steps. First, confirm current year limits with HR and official IRS guidance. Next, obtain both employers' plan documents, noting deadlines, and claim windows. For HCFSA, consider a strategic early spend if you anticipate a job change and have eligible expenses. For DCFSA, sum household contributions across all jobs, and set Job B's election so you remain under the annual household limit. Submit claims promptly with proper documentation. Upon resignation, file final claims and confirm final payroll contributions. At Job B, reevaluate your needs and elect accordingly. Monitor your totals throughout the year and adjust if your plan permits changes after qualifying events. Finally, keep your documentation for tax purposes and reconcile with your tax forms, including reviewing Box 10 of your W-2 for DCFSA. Watch out for these pitfalls. Do not assume limits are the same across accounts. Health Care FSA limits are per employer plan, while Dependent Care FSA limits are per household. Do not miss claim deadlines. Keep all receipts because substantiation is required. Avoid over-contributing to the Dependent Care FSA because excess amounts will be added back to taxable income. Confirm plan details and waiting periods at your new employer. Consider whether co-BRA for your Health Care FSA is available and whether it makes sense for your situation. Finally, verify limits each year because they can change. Here are the key takeaways. First, the Health Care FSA makes your full election available on day 1. And limits apply per employer plan. Mid-year job switch can allow a second full election. Second, Dependent Care FSA reimbursements are limited by contributions made to date, with a per-household annual limit across employers. Third, plan rules, claim deadlines, and documentation are crucial. Fourth, overages in Dependent Care FSA generally become taxable, so monitor and adjust. Finally, this video is educational. Consult your plan, HR, and a qualified professional. To summarize, verify eligibility and current year limits before making elections. Use the HCFSA strategically if it aligns with your needs and plan rules. And consider a second election at Joe B if you switch mid-year. Carefully track Dependent Care FSA contributions across your household to avoid exceeding the limit. Refer back to the timeline, flowchart, and checklist we provided. Always submit claims on time and keep accurate records. Thanks for watching. If this video helped, please like, share, and subscribe. I would love to hear your FSA game plan and experiences, so share your thoughts in the comments. See you next time.